webinar this morning, Tech Savvy webinar on FIFs and PIs, the basics. Welcome along to those of you joining us just for this morning, and also welcome to those of you on our grad pack. So this is your first of the Tech Savvy webinars after joining us for Intro to Tax earlier in the month. Today's webinar is going to be presented by myself, Ryan Ellers, and with me I have James Yeoman, and we're going to be working through the basics of the FIF and the PI regime with you today. If you have any difficulties during our webinar for our slides and or sound, please contact us at training@ph.co.nz or call the lovely Maggie on 03479 4849. Hopefully you should have had a copy of the slides already printed. If you don't, you can grab a copy of those from the handouts panel in your webinar screen. Today's webinar, we've got a few examples to go through. We don't have polls in today's webinar, but if you do have questions about anything as you go along, please do send them through and we'll try and answer them if we can and time permitting. So what are we looking at today? As I said, our webinar today is going to be around Foreign Investment Fund or FIFs and PIs. We're going to look at what is a FIF, what kind of exemptions and de minimis there are, how you calculate your income under it, what kind of disclosures you might have to make if you have a FIF, and how we deal with any foreign tax credits on our FIF. We're also going to look at PIs. First up, what are they? Obviously not just our nice meat pie that we eat. We're talking about portfolio investment entities. We're going to look at how we work out our prescribed investor rate for our PI, what that means to us and how that relates to what income tax we need to pay, what kind of expenses we might claim in relation to a PI and some common errors. And then we're going to finish up just briefly looking at an example of a portfolio report. For a lot of investors, that's the most common time we'll come across a PI or a FIF, in that they will have some kind of portfolio investment, and we'll be working off these reports. So we'll have a look at a bit of a report to see what they look like and what information we need to gather. So what are these things, these FIFs and PIs? Well, they're both regimes designed around investors mainly, and they came into effect in around the 2007 year. So the foreign investment funds, or the FIF rules, came in 1 April 2007, and the PIs a little bit later in the year in October. The FIF rules are what I'm going to be talking about today. I actually quite like the FIF rules. They're a little bit of a hard concept to get your head around because they're a bit more abstract than normal accounting. You know, you're not always just following the money. However, when you can get your head around them, I think they actually provide quite a nice, easy way to apply. Once you understand how the rules work, calculating your income actually becomes less difficult than it might otherwise be when we're dealing with these kind of foreign funds. The PI regime has a different kind of focus. It was around encouraging investment, and James is going to talk you through that a bit later in the webinar. Right, so let's get into it and let's look at our foreign investment funds. So to start off with, we should look at what is a foreign investment fund or a FIF, and I'll use that FIF term mainly throughout this webinar. So a FIF is a foreign company or a foreign unit trust, are the most common ones that you'll come across. They are also a foreign superannuation scheme prior to 1 April 2014. Post 1 April 2014, they had their own special rules, these foreign superannuation funds. And why that came about is a lot of people didn't realise they were FIF and didn't return them as FIF. So the government effectively came along and said, right, we know everyone's not been doing this correctly. If you have, keep going. If you haven't, we're going to introduce a new set of rules that deals with the fact you haven't returned income for a number of years. So that's sort of a bit of a background to them. You might come across those. In fact, you know, anyone moving from overseas to New Zealand quite likely will have those. The last one is an insurer under a life insurance policy not offered or entered into in New Zealand. Again, they're a FIF, less common, but maybe people moving from overseas to New Zealand may have them, whereas other FIFs, quite common for a New Zealander maybe to invest overseas and come across those. What's not a FIF? FIFs aren't term deposits, bonds, and debentures overseas. Those are financial arrangements. For those of you that were with us on our Intro to Tax course, we talked about them briefly. Otherwise, they're outside the scope of this webinar, but effectively taxed under a separate set of rules. Pensions, again, depending on how the exact nature of them, are often taxed as ordinary income. Where I've got a 10% or greater control in my foreign investment fund, I actually jump into the CFC rules, which are a more complicated set of rules, again, outside the scope of this webinar, but they involve where I've got more control of a company, so I may have more control, more information about it, and I'll use my CFC rules there. When do I have income from a FIF? Well, FIF income arises from attributing interest in a FIF. So what's an attributing interest? Well, again, on an easy basis, where it's shares, it's my direct income interest, my percentage of my shares in the FIF. So how many shares I have, and they will generate my attributing interest. Where I'm not dealing in shares, where I'm dealing in these foreign super schemes, it's the right to benefit from the scheme. But again, for most of the time, we're looking at shares in a foreign company, so it's my shares. That's my attributing interest in my FIF. Got a question in already for asking to confirm the split of overseas income that has New Zealand withholding tax or imputation credits along with overseas withholding tax. We'll cover that a little bit later, Sonia, so if you just bear that in mind, when I get to the foreign tax credit section, we'll talk about that particular split. What's not a FIF? Well, there are quite a few exceptions, but the main or most common one we're going to come across is an ASX listed share. So we're talking about Australian shares. So if I've got a share in America, probably going to be a FIF. Where it's in Australia, because of the sort of close nature of our border transactions, the fact that a lot of New Zealanders invest in Australia, they do have an exemption there. And that exemption applies to effectively listed Australian stock. So to qualify for that exemption, my foreign company needs to be resident in Australia for the whole time during the year. So one that's, say, was American, moved to Australia, or was Australian, moved to America, won't qualify for the exemption, needs to be Australian resident in the whole time. Same deal if they move from New Zealand to Australia or vice versa. We need to have our interest in shares, so other kinds of investments that might be listed, such as stapled stock, not going to count for the exemption. They need to maintain a franking credit account. For those that haven't come across them, a franking credit account is the Australian equivalent to our imputation credit account. So they have to be a franking credit account payer, maintainer, and pay franking credits on their dividend. And they need to be listed on an approved index of the ASX, which effectively ensures that there's relevant enough information provided so that we can actually calculate it. If we are one of these exempt ones, we're not a FIF, and we just calculate our income under ordinary rules, i.e. dividend is income, and we return it as such based on our dividend, not based under the FIF rules. Easiest way to find out if something's exempt, the ID website actually has an Australian share exemption. So if you just search Australian share exemption in the search engine, you'll get an online form, and you can simply enter the Australian stock ticker number and it will tell you their status. So that's probably the easiest way to determine whether they are. You can of course work it out yourself, but far easier just to go to that website. When else might we not be subject to the FIF rules? Well, there is a de minimis that we have, $50,000 minimum threshold, and this applies for individuals individuals only. So we're not talking about this if we've got a company. We're not talking about this if we have a trust. But if I'm an individual, so me personally, and I'm investing in foreign companies, so it should be subject to the FIF rules, so long as my original cost and all my attributing interest in a FIF is less than 50,000, then I can choose not to apply the FIF rules. Important to remember here, it's the original cost, not the market value. So if I've had quite an expensive share, maybe I purchased 60,000 worth of shares in a company, that company devalued, gone down, gone backwards, and maybe it's only worth 10,000 now. Because my cost was about 50,000, then the threshold counter has not been met, and I will be still subject to FIF. As I said, it's not applicable for companies, not applicable for most trusts. There are a couple of trusts that can do it, but generally speaking, a trust can't use the de minimis and they will be subject to FIF. It's a hard limit, so $50,001 worth of cost, they're all in, and it's a threshold, not an exclusion. So if I've got $50,001 worth of cost, then all $50,001 worth of FIF interest are caught and need to be subject to the FIF rules. I don't get to ignore the first 50,000. When we're looking at our cost, we also have to remember that dividends reinvested increase our cost. Effectively, they've given us some money and we've purchased more shares, and that is part of our cost, of which we need to include. How do we work out our cost? Well, we need to use the exchange rate on the date of purchase. So I need to know when I purchased my shares, how much it cost in a foreign currency, and then the exchange rate, turn that into New Zealand dollars, add that to my cost base. We can also elect into this regime. So even if I have less than $50,000, I may choose to apply the FIF regime. However, once I've done that, I need to stay in the regime for 4 years. So I can't jump in and out of the regime. I'm either out or I'm in. So a couple of things to look out for when we're doing it. We need to include all FIF interests. We need to find all the interests we have. We can't just do it on one share alone. We don't include exempt overseas investments. So we don't include our Australian stuff when we're doing it because they are not subject to the FIF rules. But we do have to include all the other ones we have. And if I've got two people that own a portfolio together, then normally I can take that and say it's 50,000 each. So effectively 100,000 for two people together. So now that we've decided we have some FIF interests and we've got some FIF shares, how do we go about calculating our income under the FIF rules? So there's 5 different methods we can use to calculate our income under the FIF rules. The first two are probably the most common, so the fair dividend rate or FDR method, and that's the default method, and the comparative value method. So for most people, that's about the extent of where they'll be. They'll be in one of those two methods. In addition to that, we have the cost method and the deemed rate of return method. They are the equivalent of the FDR and CV method where we don't have a market value available to us. So the cost method is equal to the FDR method, we know market value, and the deemed rate of return replaces CV where we don't have market value. The last method, the attributing FIF income method, is a bit of a special one. Sort of, again, sits outside the scope of our webinar today, but just to give you a brief background of what it is, the attributing FIF income method is the equivalent of the CFC method for FIF shares. And what it does is it has a semi-look-through method, and you need to know a lot more about your FIF because you effectively take the FIF's income, not their dividend, but their income, and attribute some of that to your shareholder. When does it apply? It generally applies for bigger interests in a FIF. So we're talking about greater than 10% interest in my FIF, where I might normally be subject to the CFC rules, but some kind of exclusion has stopped the CFC rules applying to me. The attributing FIF income method may then be appropriate. As I said, it is effectively the CFC method, however it applies to a FIF. What's special about the FIF rules is that they're what we call a code. What does being a code mean? It means that it overrides all the other rules in the Income Tax Act. So if my FIF rules apply to me and my interest, then all the other income tax rules won't apply. I simply calculate my income under the FIF rules, and that's the end of it. So if we take, for example, a share trader, somebody that trades in shares, ordinarily, if they were buying and selling shares on the New Zealand Stock Exchange, then the capital gains on those shares would be taxable to me. Yep. So when I buy it, intending to sell it, when I sell it, income for the cost that I get of disposing of it, deduction for my cost of purchase. However, if those shares are FIF shares, then that rule doesn't apply. I don't do the gain or loss kind of calculation there. I simply calculate my income under the FIF rules, and that's the end of it. That's the income that I put in my tax return. The codification only applies to those first four methods. As I said, outside the scope of this webinar, but the attributing fifth income method doesn't get the benefit of that codification. So it would still be subject to other income taxing rules. Let's have a bit of a look now at some of these specific methods that we have to calculate income under our FIF rules. So the first one we're going to look at here is the fair dividend rate, or FDR method. And as I said, this is the default method used by most entities, and in fact, pretty much the only method available to a company. Under the FDR method, our income is calculated based on 5% of the opening market value at the start of the year. So it's quite, as I said earlier on, once you get your head around these kind of rules, not too difficult to apply. I simply take my opening market value, how much my shares were worth on 1 April, assuming a 31 March balance date, and multiply that number by 5%. That number that I get is my taxable income, put that in my tax return, and I pay tax on that in New Zealand. What about the actual dividends paid by the FIF? Well, as I said, the FIF rules are a code, so I only return income under the FIF rules. The dividends themselves are treated as exempt income and are ignored. You still might want to record them for accounting purposes. For example, here we still show them as income received in our P&L. However, when we come to do our tax return, you ignore those and you just use the 5% of the opening market value. What's a bit special about these rules, or a bit weird, is we're only looking at the opening value at the start of the year. So generally speaking, I ignore sales and purchases that happen during the year. So what does that mean if we think about it? Well, what about if I purchase some shares, if I have no shares, FIF shares at the start of the year, and then I go and purchase shares on, say, the 3rd of April, my FIF income is going to be zero for the year. Because at 1 April, the date that I care about, I had $0. $0 times 5% is still zero. Compare that to the other way. What about where I held shares at the start of the year? Let's say at the start of the year, I had $10,000 worth of shares, and then I sold those shares on 3rd of April. What happens here? Well, in fact, I end up paying tax on that, $500. $10,000 starting opening value, times 5%, $500, that's what goes in my tax return, even though I only held those shares for 3 days. Where else can it become a bit of an issue? What about if my shares become worthless? On 1 April, my shares were worth $10,000. 3 months down the track, the company goes under. Worthless shares that worth $0, I still end up paying tax on that at 5% of my opening market value. The other special area is where I buy and sell shares during a year. So as I said, generally speaking, we don't care about purchases and sales, but where I buy and sell the same share during a year, I may have to make an adjustment. And we'll have a look at that adjustment in a couple of slides. So again, this slide here is just confirming our calculation formula, 5% of the opening market value plus my quick sale adjustment. What's my quick sale adjustment? My quick sale adjustment is the lesser of two amounts. So it's the lesser of the peak holding adjustment and the quick sales gain. What's the peak holding adjustment? Well, the peak holding adjustment effectively adjusts my opening market value or cost based on purchases and sales. So it says I had an opening market value, but then there was actually some shares I bought and sold during the year. I'm going to include the cost of those purchases in my opening market value. What about the quick sale gain? That looks at it from the other side and says, okay, I might have bought and sold some during the year. What we're actually going to do is look at effectively our capital gain on the sale of those shares and include that as income to me. How do they actually work? Well, the peak holding adjustment, first we have to work out what our peak holding is. So what was the maximum number of shares that I had during the year? Simply add up all my shareholdings at various times of the year and then compare that peak holding number to my opening and my closing share value. And the smallest difference is my peak holding differential. I then take my peak holding differential and multiply that by my average cost. And that's my peak holding adjustment. What about my quick sale gain? Well, my gain is the amount that I derive from disposing of the interest, or holding it, so that can be dividends as well. So if I sell some shares, that's my gain, how much I got for them. My interest is the number of shares that I had. And then my average cost, similar to my peak holding adjustment, is the average cost of acquiring shares during that year. So let's have a wee look at an example here. So here we've got a person that started with 10,000 shares worth $200,000 on 1 April, purchased 5,000 shares in October at $110,000, sold 4,000 shares in December for $100,000, purchased some more shares in December, 2,000 of them for $44,000, and had a closing value of $292,500, extra zero in there. Don't need that one. And we've got these shares going throughout the year down in our right-hand column. So let's look at our peak holding adjustment. So what's our peak holding adjustment? Well, the maximum number of shares I had during the year were 15,000. I started the year with 10,000, so a $5,000 difference. And then I finished the year with 13,000, so a 2,000 difference. So my peak holding differential was 2,000, the smaller number. What about my average cost? Well, I purchased 2 lots of shares during the year. The first lot for 110,000, second lot for 44,000, and that was a total of 7,000 shares. So 110 plus 44,000 divided 7,000 gets me to $22. So my peak holding adjustment there. What about my quick sale adjustment? Well, my quick sale adjustment was my gain. Again, going back to that slide, I sold my shares for 100,000. How many shares did I sell? 44,000. We already calculated my average cost at 22,000. Therefore, my quick sale gain is 12,000. 100,000 less than 4,000 times 22. So we've got $12,000 for a quick sale adjustment. We've got peak holding adjustment of $22,000. Therefore, I'm going to take the lesser of the two, peak holding adjustment, 22,000, and include that in my formula. What's my total FIF income for the year? Well, we got 5% of our opening market value of 200,000, plus my quick sale adjustment, 2,200, gives me total FIF income, $12,200. Ignore any dividends that came in during the year. I simply put the $12,200 in my tax return. It couple more questions come in during that. With FIF income, when are you allowed to use line-by-line calculation, and how does this affect income and tax credits? Can we apply tax credits to other income? Again, I think we'll come back to the tax credit stuff a bit later in the webinar, Sonia. However, to answer that briefly, FIFs are treated, each FIF is treated as its own segment for foreign tax credit purposes. So you apply line-by-line calculation to your foreign tax credits for each and every FIF. Can you apply the tax credits to other income? No, you can't. There's a limitation that effectively limits your foreign tax credits under the foreign tax credits rules to the amount of income tax payable on that segment of foreign income. So effectively, it will prevent you from using those foreign tax credits against other income. Not specifically, but in practicality, that's what it does. Do you still get a credit for tax paid on dividends even though you don't declare the dividend? Again, we're going to come to credits later in the webinar, but yes, you do. Can you alternate FDR and CV method? Yes, again, we're coming to that. So a few of these questions I think we'll answer as we go on. Comparative value method, so this is our second method. So we've looked first at FDR, now we're looking at comparative value. What does comparative value do? Well, it effectively looks to tax your capital gain. The government will tell you we don't tax capital gains in New Zealand, but we do, we just don't call it that way. And our comparative value method is effectively that calculation. So how do we work out our income under that method? We take our closing market value plus any inflows, so gains during the year. That could be dividends, it can be sale of shares, and from that we deduct our opening market value and any other costs we've incurred, so any other purchases. So effectively what we received less what it cost us, the difference between the two is our income under the CV method. What kind of things do I also include in my costs? I can also include tax credits, foreign withholding that's been taken off my dividend. However, compare that foreign withholding to tax credits. So I don't include my tax credits, I do include withholding. So things like franking credits, which are a credit, are ignored in this calculation. But if I've had US withholding tax, then that goes in my cost box. If I have a loss from the CV method, so my closing market value is less than my opening market value, for example, shares have gone back in value, I don't get to claim that loss generally. So that loss is limited to zero. So I just put no income in my tax return. That position has changed a little bit for certain CV shares where they are guaranteed return type investments. And we often call these or refer to these as forced CV shares. And what are these kind of shares? They're kind of shares where we guarantee the foreign entity guarantees that we're going to get a return from them. And the idea effectively come out in a determination and say, for these shares, you have to use CV. You don't have a choice of using one of the other methods. You must use CV. Where that's the case, we are entitled to claim our loss. So if we have a forced CV share, we can put our loss in our tax return. It can offset other income. Where it's just a CV share where we've chosen to use CV, no loss is allowed. Companies can't use the CV method, only natural persons and trusts. So companies have to use FDR or one of the other methods. However, that position again has changed for those forced CV shares. So if we have a forced CV share, a company can use it, but that's only where the IRD have effectively said to us, you must use CV for these shares. Hopefully this is the question that you were looking to have answered here, Dawn. How do FDR and CV interact together? Well, if we're an individual or a family trust, we can freely swap between FDR and CV. We have to make that choice year by year. So I can do FDR one year and then the next year do CV. There's no restriction on me swapping between them. However, I have to use it globally. So I have to do all FDR or all CV. I can't choose to do one FDR and one CV. If I choose to use FDR, I use FDR for all my interests and a FIF. If I choose to use CV, then I use CV for all my interests. You're entitled to change purely because it's better for you. So where my CV gain is less than 5% of the opening market value, i.e. my income calculated under the CV method is less than the income calculated under the FDR method, then I'm probably going to choose the CV method. And I'm entitled to do that simply because of that reason. Where I've got those forced CV method ones, so those ones I'm not allowed to use FDR, I can take them outside that grouping. So I could use FDR where I've got CV shares where the CV shares are forced. So if the ID tells me I have to use CV for one lot of shares, then I take those ones, put them in the CV method, and then all the remaining FIF shares I have, I can then make my choice based on those alone and simply go FDR CV for the rest of them. FIF income is returned in the overseas investment box. That's just a bit of a comment there about where you need to put it in your tax return, but it represents overseas income. And so it should go in the overseas box. So let's have a wee look at an example comparing the two methods. So here we have three companies that are all FIF companies, company A, B, and C, all had opening market values of 100,000. Therefore, they all have FDR income 5,000 apiece, or 15,000 in total. However, they performed a bit different over the year. Company A, small gain, 102,000 ending value. Company B did slightly better, 110,000 by the end of the year. And Company C had a bit of a bad year. They went backwards. They were only worth 80,000 at the end. So there we can see our CV calculation. Company A, $2,000. The gain it had. CV for B, 10,000, and a 20,000 loss for Company C. So my total CV income for the year is a loss of 8,000. Because it's an electable CV calculation, that's reduced to zero. So effectively, I'm comparing $0 and 15,000. CV is still the better answer for me. I put $0 in my tax return. Don't pay any tax for that year. If Company C was a forced CV company, so the ID said you must use CV for Company C, then I'd take the 20,000 and I'd get to have that loss. I'd put the $20,000 loss in my tax return. I would then compare Company A and B, and I'd say, well, Company A and B together, 10,000 FDR income, 12,000 CV income. I'm in fact going to use the FDR method for A and B. So I would put in my tax return 10,000 of FDR income and a 20,000 forced CV loss for a net negative 10,000. So important to differentiate between where I've elected CV and where I have been forced to use it, because it does give you a different answer. What information do I need to have when I'm doing these calculations? Well, I need to have my opening share values. I also need to have my costs, but that's only to work out de minimis. I need to know how many shares I purchased and for how much. I need to know how many shares I sold and how much. I need to know any dividends that I've had during the year. And I need to know my closing market value. All that information together should be enough to let us calculate our FDR or CV income. So you'll notice that both FDR and CV required me to know my opening and closing market value, so it was important that I had a way that I could determine those. Easiest way, listed on a stock exchange, I can look up the stock exchange listing and work out their market value. Sometimes there are markets outside of a stock exchange, however, for the most part, that is the easiest way. But what happens if I don't have that information? Well, that's when those other two methods come in. So we have the cost method, which is our FDR equivalent with no market value. The calculation for my FIF income under cost method is very similar to my FDR. It's simply my opening cost times 5%. So whatever I paid for these shares, times that by 5%, that is my cost income under FIF. However, that doesn't really work that well for the IRD, where I get to keep the same cost for ages, because imagine, we expect or hope that our shares are going to go up in value. So how do they deal with that? They increase my cost by 5% every year. So my cost when I purchase the shares is how much I paid for it. The next year, my cost is what I paid for it last year plus 5%. Next year, I increase my cost by 5% again, so it keeps going up. For smaller holdings, not too bad. A 5% increase, not going to be the end of the world. But imagine if I've got quite an expensive sort of share, that number can go through the roof quite quickly. So my example before, 100,000 times 5%, 5,000. But the next year it's 105,000 times 5%. So we're going to increase it by 5,050. Next year, 110,000. So you can see that my cost can go up quite quickly under this method. How do we deal with that? Well, once we've used the cost method for 5 years, I can go out and get an independent valuation and reset my cost based on that valuation. What about the CV equivalent? Well, the CV equivalent is called the deemed rate of return. How this one works is, because we don't know opening and closing market values, we simply work off our cost again. And the IRD provide a rate each year, which they say is the deemed rate of return we would expect from a foreign share. Currently, that rate's 6.44%. So you calculate your deemed rate of return by taking your cost times your deemed rate of return plus any dividends received. So the deemed rate of return is the expected capital growth, plus you still return your dividends under this method. How do we calculate our cost? Well, our cost is our cost plus our book value. And our book value is last year's book value plus any purchases, less any sales, plus last year's FIF income. So once again, we're looking to increase our cost by our deemed rate of return. Very similar to the cost method, we effectively keep increasing our cost base by our returns in our prior years. The deemed rate of return also has a couple of other catches to it. If my gains line, so my proceeds from my sale, is greater than my deemed income, then I simply put my deemed income equal to my gains. So I increase my deemed income based on any capital gains that I've effectively made. As I said before, backdoor capital gains. So those cover off the 4 main methods that we're going to deal with here. Again, as I said, attributed FIF income method is available, a bit more complicated, very seldom used. I think I've only ever used it once over my time so far, whereas the other ones you come across a bit more frequently. What else do I have to do when I've calculated my FIF income? Well, I have to make disclosures to the IRD. So I have to tell the IRD about what FIF interests I held and how I calculated my income under that. That disclosure is made outside my tax return. There is a box that you tick in your tax return to say you've made a disclosure, but you have to make that disclosure separately. There are a number of different IRD forms for making those disclosures depending on the method we use. However, when you do it online, it's simply a single online form, and you simply click your way through that and list all your FIF shares in one go, all the methods, how you calculated it, and send that off. There are some times I don't need to make a disclosure, and I don't need to make a disclosure if I'm using those first 2 methods, the FDR and CV method, and I'm not a widely held entity, so smaller individuals, trusts alike. And the FIF investment is in a country where we hold a DTA with. A DTA is a double tax agreement. We have a number of those with a number of countries around the world which effectively prevent double taxation between them. So long as we have a DTA with those countries and my FIF interest is in that country and I'm a small holder, I don't have to do a disclosure. So for most people, that knocks out the majority of people from having to do them. However, that DTA question can be a bit interesting. An example that I can think of is OMIP, which are resident in the Cook Islands, of which we don't in fact have a DTA with, which means that you have to disclose OMIP shares, even though you use FDR or CV method. Right, on to foreign tax now, where we've had a few questions coming in. So again here, I'm looking at foreign tax in relation to our FIF income. So not specifically looking at the foreign tax credit rules themselves. Those are covered in other webinars. However, I will give a brief overview. So what does it mean for a foreign tax credit? In New Zealand, I'm entitled to claim a credit for foreign tax paid by me on foreign income, so long as that credit or that tax that I've paid has the same type or nature as New Zealand income tax. So we're looking at things like withholding taxes and foreign income tax. We're not looking at things like credits such as franking credits. They have a different type of nature, but we're looking at, again, like I said, foreign tax credits. Mainly those withholding tax are the ones that we're going to see most often against FIF income. How much of it can I claim? Well, I can claim it up to the amount of New Zealand income tax payable on the FIF income associated with that credit. So I look at how much FIF income I have from my FIF, calculated under FDR or CV, so maybe 5% of the opening market value. I look at how much New Zealand income tax is payable on that 5%, and that is the limit of how much credit I can claim against that income. The credit has to be also linked to that income, and I think there was a question from Tony, do you still get the credit even though the dividends are exempt and you calculate income under the FIF rules? Yep, so the Income Tax Act says that for the purposes of the credit, we pretend the credit is attached to the FIF income, not the dividend. So take my dividend, take the credits off it, attach those effectively to the income I calculate under my FIF rules, and line it up that way. If I've got an overall CV loss, I can still sometimes claim a credit for foreign tax credits. So in answer to Sonia's question, for a FIF, I calculate my tax credit on a line-by-line basis. So each FIF is a separate line. So I might have a CV gain on one piece of income and a CV loss on another. If I have foreign tax credits attached to the gain, the income part of the CV, I can claim my foreign tax credit against that, so long as overall I still have tax to pay. So remember, I have to look at my New Zealand tax payable on that income. If overall I'm in a loss position, there is no New Zealand tax payable on that income, therefore I have no credit to claim. However, if I had other income elsewhere, I then apportion that income, the New Zealand tax payable over all my income, take the apportioned amount against that CV income, and then say that's the limit of my tax credit. We'll have a wee look at an example to show how that works in a couple of slides. In order to calculate it, you do need to have a bit more information. You need to know the line-by-line calculation of your FIF. Easy if you've done it. If it's coming from a portfolio, you'll need the actual full portfolio report to be able to see that line-by-line information. If I don't get to claim my tax credit because I'm in a loss position or I've overpaid my foreign tax, I don't get that refunded and I don't get to carry it forward. It's simply lost to me. So important to ensure that we don't overpay our foreign tax, whether that's informing the other country about DTAs, which often limit it. That may be the answer. Sometimes you can actually go to the foreign country and get a refund over there. What type of foreign tax credits are we looking at? As I said, mainly withholding tax. There are sometimes some other tax credits we do, but you need to have a close examination of them to determine if they are in the same nature as New Zealand income tax. So some key examples of ones we can't claim are Australian franking credits. We don't get those. And UK withholding tax, even though it's called withholding tax, What I am told is it's not actually a withholding tax, it's a different type of tax credit regime and is not claimable. What about New Zealand tax credits? And I think we had a question about that as well. There are times that you'll get New Zealand tax credits attached to foreign income. Two key examples. One is some Australian companies, closely held mainly, will maintain an imputation credit account, so will attach imputation to their dividends. Sometimes as well, you'll have a situation where there is somebody in between you and the foreign entity, and they will withhold tax on your behalf. Some fund managers will do that, so you end up with New Zealand RWT on your FIF. Can we claim those? Yes, we can. If it's an RWT type income, then there's no restriction on it. You simply claim it, even in a loss position, and you'll get that refunded. Not subject to any of our foreign tax credit streaming type rules for RWT. So just put that in your tax return, claim it. You'll need to make sure it's not in a foreign tax credit box. So generally you put that in your New Zealand dividend box and attach correspondence saying it was due to a mismatch of FIF income. Imputation credits used to be just claimable as a whole. From 1 April 2014, we still get to claim them. However, we limit them to the same ratio, 28/72 maximum, or 28% of our FIF income. So if I have a $10,000 dividend and I get $3,888 of imputation attached to it, maximum ratio. However, under FIF, I only return $5,000. I effectively halve the imputation I'm allowed to claim. I take my $5,000 times that by 28/72, and that's my maximum imputation. What I do with those imputation credits? Well, if I'm using my FDR and cost method, they override that codification and become income to me. So I increase my FIF income by the amount of imputation that I'm allowed to claim. Make sure we get to the right ratio. If I'm using CV or deemed rate of return, I don't have to increase my FIF income, but imputation is included in that gains line. So they're already part of the calculation. So let's look at a bit of an example. We've got a New Zealand $10,000 dividend. So it's a FIF dividend. We've converted it to New Zealand dollars. And with that, we had $1,500 of withholding tax attached. The dividend was subject to the FIF regime, so the $10,000 dividend is not directly taxable. It's exempt income. We ignore it. Taxpayer can use FDR or CV. FDR was calculated at $5,000, CV at $12,000. Seeing as FDR is lower, we'll use the $5,000. We've got some other income from other sources of $70,000. So we've got total income for the year, $75,000. 70 plus 5,000. Sorry. What's my New Zealand tax on the 75,000? 15,670. How much of that's attributable to the FIF income segment is 1,044. So we take the 5,000 over the 75,000 times the total tax payable, 15,670, $1,044. That's less than the total withholding I had of 1,500. Therefore, I'm only allowed to claim the $1,044. That's the amount that's attributable to New Zealand income tax. How do we go about converting currency? Obviously an important question, as most of our foreign income is going to be in a foreign currency. Well, the default method we do is we calculate things based on the actual rate for the day of the transaction. Day I purchased it, currency conversion rate on that day, that's my currency conversion. ID do allow us to use some other methods. We can use a rolling 12-month average for 12-month accounting period or an income year, and that's appropriate where the income is earned over a whole year and we don't know when it was earned. or where we know the month but not the specific day, the IRD provide us a mid-month actual rate, which we can use for a monthly calculation. However, we need to use the same method for all transactions in a year and every year thereafter. What are some common errors we see in the FIF regime? Transitional residents, so people that have moved to New Zealand and never been here before, get 4 years where they can still treat themselves as non-resident for certain things, so they don't have FIF income in that transitional period. Claiming a CV loss when we only optionally chose to use the CV method. We can't have that loss, it's limited to 0. Conversely, where we're forced to have a CV method, we can claim our loss and not always done. Where we have those New Zealand tax credits, so RWT and imputation attached to overseas income, people include that as a foreign tax credit in their tax return. The IRD will deny that under the foreign tax credit rules sometimes because it doesn't meet those criteria. However, it should be put in a different box and simply noted to the IRD that it's New Zealand RWT on foreign income. The other one is overclaiming that foreign tax credit, generally by not doing your segment calculation correctly, so that we're looking at an overall rather than a per segment box. Bruce has asked a question, how can a New Zealand dividend be subject to FIF regime? No, it's the other way around, I think, Bruce. So New Zealand dividend won't be subject to a FIF regime. However, certain foreign companies maintain New Zealand imputation credit accounts, mainly Australian, and some foreign companies will also deduct New Zealand RWT. So it's still a foreign share, not a New Zealand share, but it may have New Zealand tax credits attached to it. Again, we're looking mainly at certain Australian companies. New Zealand, and then second question from John, New Zealand RWT for FIF can be claimed under NZ dividend income part of the tax return. Should we allocate part of the FIF income to NZ dividend income? No, we shouldn't do that. The FIF income is still foreign. You'll put it in the New Zealand dividend box with no income against it. So you'll have gross income, nothing, and then have RWT and imputation in the appropriate boxes there. Then you need to attach correspondence to your tax return, informing the IRD, so you say in the correspondence that the credits relate to a mismatch due to the FIF regime. Again, it's mainly because it's not in the Act anywhere, that's simply instruction from the IRD, because the tax returns can't actually cope with it. There's no box against foreign income to show New Zealand credits, so this is how you have to get around that issue. Perhaps with the new system, as we move to more electronic, there will be boxes, but at this stage, that's how we do this. Right, so that concludes our section on foreign investment funds. I'll now hand over to James and we'll look at portfolio investment entities.
All right, so I'll be going over PIs. So a PI is an entity which invests the contributions of investors into different types of passive investment. They were basically designed to provide an incentive for people to save. So generally an investor in a PI will be taxed at a rate that is lower than their normal marginal tax rate. There are 4 main types of PI fund: the multi-rate PI, the listed PI, benefit fund, and the life fund. So today we're going to be focusing on the multi-rate and the listed. These are the most common types that you're likely to come across with investors. So first up is the multi-rate PI. So a multi-rate PI calculates tax on investment income using a prescribed investor rate known as a PIR. All income, losses and tax credits are attributed to the investors, and the PI pays tax for each investor based on their prescribed investor rate, which they have chosen. So there are 4 rates available, and we will look at these in more detail later, as some are available to some entities and not to others. Distributions, such as dividends paid out, are treated as exempt income, and if the correct PIR has been chosen, then generally the attributed income will be excluded from the investor's tax return. So when a multi-rate PI makes a loss, then the investor can only claim that loss if in their tax return if they have used the 0% PIR. Where an investor has a PIR greater than 0%, then the losses are cashed out. So this means that a PI fund itself will claim a tax rebate from the IRD based on the investor's PIR that they've elected. The rebate is then credited to the investment balance or paid out to the investor. This is a similar result to if the investor had been allowed to claim the loss in their tax return against other income. So we've got an example here. If there was a loss of $1,000 and the investor had a PIR of 17.5%, then because the PIR is greater than 0%, the loss can't be included in their tax return. In this case, the PI fund would claim a rebate from the IRD directly and credit it to the investor's investment balance or pay it out. And this tax rebate is exempt income as well. So still on multi-rate PIs, picking the correct PIR is very important. So if a rate is selected that is too low, then the investor will need to include this income in their tax return. This effectively means the income will be taxed at their marginal tax rate and the tax benefit of being in a PI is lost. If a PIR is selected that is too high, then it is treated as excluded income and the overpayment of tax can't be recovered. So it's quite important to get that rate right. The 0% PIR rate, so if this one is used, then the attributed income or loss must be included in the tax return. One to watch out for here is when an investor withdraws their funds. So some PIs will automatically change an investor to a 0% rate in the period that they exit the fund. And if that is the case, then you will need to include their income as assessable, even if previously they'd been on the right rate. If no PIR rate is advised, then the default rate is 28%. And there are some different rules there for foreign investors, which we will cover off later. So where does multi-rate PI income go in the tax return? So IRD have advised that multi-rate PI income needs to go in the overseas income box. This may not seem technically correct, but it is what the IRD have advised should be done at this stage. In terms of tax credits, where they are non-specified and referred to as PI tax paid, then they will go in the foreign tax credits box. If they are specified, such as RWT or imputation credits, then they will go in the relevant box for that tax type. So, for example, with New Zealand RWT, this would go in the New Zealand interest section of the tax return with no corresponding income. And you would need to attach IRD correspondence to explain why that has been done. Excess PI credits should be refundable for companies and trust beneficiaries, but they're not refundable for individual investors. So now we'll look at how to determine the PIR rates for various entities. So first up is individuals. There are 3 rates available: 10.5%, 17.5 or 28. The 0% rate can't be chosen for an individual, but as I mentioned previously, sometimes they may be switched to this rate in the period that they exit the investment. So the correct rate for an individual is found using this table below. And the important thing here is to look at the lowest rate from the previous 2 years. So looking at the table, someone earning up to $14,000 of taxable income and up to $48,000 of excluded and taxable PI income can use a 10.5% rate. So the result here is that PI income ends up being taxed at a bracket lower than it otherwise would be. If held in a partnership, then you would look at the highest rate of each partner. There are also some implications for student loans, working families, and child support. So regardless of whether PI income is assessable or non-assessable in the individual's tax return, it will still need to be included when calculating end-of-year obligations for each of these. The only exception here is for locked-in PIs, such as KiwiSavers or retirement schemes, which don't need to be included. So we've got an example here showing how to work out what PIR to use for an individual. So you can see this person has a mixture of taxable income and PI income, which varies from year to year. Using the table on the previous slide, we can work out the rate for each year based on their income. So for 2016, we can see they've got $10,000 of taxable income and $10,000 of PI income, which would indicate a rate of 10.5%. For 2017, if we go through the same process, they would end up with a rate of 17.5%, and so on. So the PIR that the individual elects to use is based on the lowest rate of the previous 2 years. The current year income doesn't matter when working out your PIR. So if we look at 2018, they've elected to use a PIR of 10.5%. So this is the lowest of the 2 rates in the 2016 and 2017 years based on the income in each of those years. So PIR for non-residents. So overseas investors can be treated as either a non-resident investor or a notified foreign investor, which is an NFI. A non-resident investor must use a PIR of 28%. A notified foreign investor can use multiple rates between 0% and 30%, and the rate used will be determined by each PI that they invest in. So to become a notified foreign investor, there is various information that needs to be provided. Additionally, an NFI must not be a New Zealand resident, a controlled foreign company, a FIF with a New Zealand resident investor who has an income interest of 10% or more, or a non-resident trustee that isn't a foreign trust. So there are 2 categories of PI for NFIs, which come under the multi-rate PI rules. So we've got the 0 rate PI and the variable rate PI. So these were created due to foreign investors previously being overtaxed when they were being treated as a standard non-resident investor, which had a rate of 28%. So now PIR rates for trusts. So there are 4 different rates that can be used for a trust between 0 and 28%. The rate chosen will generally depend on whether the income will be retained in the trust or distributed to beneficiaries with a lower marginal tax rate. So we've got charitable trusts use 0%. Only estates can use the 10.5% rate, and the default rate there is 28%. When it comes to the tax return, if a 0% rate is used, then the income or the loss must be included in the return. If either the 10.5% or 17.5% rates are used, then the income must be included. But if there is a loss, then it can't be claimed. But as we talked about previously, the PI fund itself would claim a rebate for that loss and credit it to the investor. And if the 28% rate is chosen, then that is a final tax and any income or losses are not included. So the PIR for companies. Companies must use a 0% rate. Non-resident companies use a rate of 28% unless they become a notified foreign investor, as we talked about before. All attributed income or losses must be included in a company's tax return. So essentially, there isn't any real tax benefit for a company to invest in a PI compared with other entities. And dividends or distributions received are excluded income. So that's all on the multi-rate PI. The next most common one we're likely to see is the listed PI. So some features of these, they must be listed on a stock exchange in New Zealand. They don't pass losses to investors like a multi-rate PI does, and they are subject to a flat tax rate of 28%. In terms of distributions to investors, these are generally made in 2 parts. So there will be an imputed dividend portion and an unimputed portion. The unimputed portion is always excluded from the tax return. The dividend portion includes 28% imputation credits and no RWT. And this portion can be included or excluded depending on the entity. So trusts and individuals can choose to include this income. So if their marginal tax rate was below 28%, or in the case of a trust, you'd be looking at the individuals or the beneficiaries that the income would be allocated to. So if they had a rate below 28%, then it would be beneficial to include the income and claim the tax credits. Companies must include listed PI income in their tax return. So now we'll just finish off with a few common areas to watch out for with PIs. PI losses, so remember these can only be claimed in a tax return when the investor has a 0% PIR, and they can't be distributed to beneficiaries when incurred in a trust. Identifying when an investor has been 0 rated on exit. So if an investor is changed to a 0% rate, then that income will need to be included in their tax return, even if they have been on the right rate previously. So you just need to check that if you know that they've pulled their funds out. And calculating PIRs, so we need to make sure that all PI income is taken into account when the investor has more than one PI. And the last one there, when looking at income to determine what rate to use for an individual, It's the previous 2 years that are important, not the current year. So you need to have a bit of previous data there to work it out. So that is all from me on PIs, and Ryan will take you through an example of a portfolio report to finish off.
Thanks, James. So you'll note that a bit similar to my FIF examples, there was direction from the IRD for the PIs to put the multi-rate PI in the overseas income tax box. Obviously, that only applies where we're having to return it, so it's generally where someone's got the wrong rate or a 0% rate. Doesn't apply to the listed PI, they should stay in the dividend box. I have some issue with the direction to put it in a overseas tax box. It's what the IRD tell us, so we should probably follow them. The reason they do that is they're really only concerned with the 0% PIR, where you actually take the same nature of the tax credits through to your tax return. So a 0% PIR may have some foreign tax credits attached. They want to ensure that those foreign tax credits are correctly limited, which is why they tell you to put it in the overseas box. If I'm a 17 or a 10.5% PIR payer, my tax credit is simply a PI tax credit. That tax credit isn't subject to my overseas income tax rules about that limitation that we talked about in the fifth one. So my issue with the instruction to put it in the foreign tax credit or the overseas box becomes where the IRD system then tries to deny a tax credit based on that apportioned income tax calculation we discussed in the fifth regime. So I guess what I'm saying is we should follow what the IRD is doing, but we should be very careful if they come back trying to deny a tax credit from a PI, because most of the time we shouldn't be denied. As James said, PI tax credits can also be refunded at times, and if we've got in that overseas box, they won't allow that refund. So just be a bit careful when we are doing it to make sure that we understand it, and if they come back denying a credit, we understand why it was denied and if that was correct. So to finish up our webinar today, we're just going to have a look at an example investment report. It's only one report and one format. They come in lots of different formats. However, this just has a bit of an example of what you might see throughout a throughout an investment report. So here we've got the front page of a report. This one here has a very nice summary of the investment income we have. A couple of points to note. Up the top there, they've got the rates we've told the portfolio about. So we've got our PIR rate at 28%. We're going to exclude our PI income. It's the top rate, always excluded. We've got our RWT rate, different to our PIR rate at 33% because we're a trust. We've decided we're probably going to keep the income in the trust. We then have all our different types of income listed down the page. So the first bit is our New Zealand income. That's just ordinary income. Put that in our income tax, interest income tax box. We don't have any New Zealand dividends and we don't have any overseas interest. We also don't have any dividends in this particular portfolio exempt from FIF, so none of those Australian dividends. But we do have some dividends subject to FIF. So you'll see there we've got $28,584.93 of overseas FIF dividends. That is exempt. That $28,000 exempt doesn't go in my tax return. It does have attached to it $642.22 of tax credits. We may be able to claim those. We've also got some monitoring and administration fees, and they may be deductible to us down the bottom. So how do we know about what to put in further? We have to look further into our report. This report has some PI income, and this is my PI income summary. As we talked about before, we're using a 28% rate, so it's excluded income. You can test that against taking that $19,631, times that by 28%, you'll get the $5,496. That's about as far as you need to go when we're using a rate other than 0%. While it's got the next two boxes, tax credits claimed and net PI tax paid rebated, that's for your information only, telling them how they came about calculating or paying that 28% they needed to pay. So long as I'm more than 0%, it's only that gross tax paid box that I really care about. If I had to put it in my tax return, so it's 17.5%, I'll put in the taxable income loss and I'll claim the gross tax paid, one line. Below that, we have our listed pie, and it's been separated into the two sections. The unimputed portion, which is excluded, so it's at $3,139, doesn't go on my tax return ever. And the top portion, $9,369 with $2,623 of imputation, that's my optionally included box. So I have to decide, am I going to include it? Is it going to be received by a final taxpayer with less than a 28% tax rate? If so, I'll include that. Moving further into the report, I have my FIF calculation. These guys have done it for us. So remembering I excluded my 28,000 FIF dividends on the front page, and then they've done our calculations. So the top part is my FDR calculation. $0 opening market value. I didn't have any during the year. I purchased them all. 0 times 5% is 0. Further on, we have the CV calculation, which has an opening market value and a closing market value. These FIF shares went backwards, and therefore we've ended up with $0 again. So I actually had a CV loss because it was optionally CV limited to 0. Therefore, my FIF income is 0. You'll note that I also have some compulsory CV method or forced CV. These ones actually made a gain, $47,572. And those there go on my tax return. If that had been a loss, then I will get to claim that loss. They've given me some information about my interest income and my tax information. Again, that's just an ordinary income. Put that in my tax return, claim the $979 of withholding. They give us a schedule of the dividend income subject to FIF. This schedule is important. As I said, the actual dividend, the 27,000 odd, is exempt. However, it does tell us what credits were attached, the $642, what dividends those were attached to. And this is the example that I think Sonia was asking about earlier. When do we do it line by line? Well, this is a good example here. I've got $642 of credits. However, my FIF income was 0, so I can't claim it for most of it, apart from that forced CV. Later on, we'll actually see which particular shares made up the forced CV, but in this particular example, it was only 4 of those dividends. So of that $642, I'm only going to be able to claim about $7 as foreign tax credits. The other parts relate to FIF income where I had no FIF income, therefore no New Zealand tax, can't claim any. We've got some fees that were charged to us by the portfolio manager. We need to consider these on a case-by-case basis to determine if they're deductible, but as a general rule, implementation fees, so the fees of putting the portfolio in place, are normally considered to be capital in nature, non-deductible. The ongoing monitoring and administration will be deductible to us. Here's a breakdown. They also provide us a breakdown of our multi-rate pie income and how we deal with it. Again, you can normally do this off that front sheet. So long as they're all at the same rate, 28%, they're all going to be excluded. Don't have to go into too much detail here. If I had 2 different rates, so sometimes I will have one pie at a different rate, then I'll need to look on an individual basis. It gives you a big breakdown of the tax credits and the type. Again, as I said, that's only relevant to me when I use a 0% PIR. If my PIR is greater than 0%, that tax credit box is really for your information only. I don't use that. I simply use the gross tax paid because the credit is claimed by the pie and converted effectively into a pie tax credit. So don't try and put those tax credits into your tax return. If you're putting pies into a tax return, unless you're using a 0% PIR, and then those tax credits are relevant. Otherwise, single line, one entry. The second to last one we've got here is a listed pie schedule. Again, simply giving you information about your listed pie. Generally, you can do that off the summary. You don't need to come into this particular schedule. It just provides a listing of all of the information. Continues over 2 pages. The only important part to note down here is the unlisted pie distribution at the bottom. And that there is a always exempt. So my unlisted pie, so that's my multi-rate pies. Remember, the distribution, as James said, is always exempt. The only part that's taxable is the attributed part, and only when I've got the wrong PIR. Again, do that off the front sheet. Here's the schedules I was talking about that we need to refer back to when we're trying to calculate our foreign tax credit. So this schedule here is my calculation of my CV. It breaks it down into each individual share that is in the CV. They'll provide one schedule for the CV calculation, one schedule for the FDR calculation. The FDR example is not included. However, what is included is the comparative value, the compulsory method. So these are my forced CV ones. So what I need to do is grab my forced CV. Here we've got dimensional 5-year diversified FI and dimensional global bond trust. Take those and go back to that schedule that provided the exempt dividends. Find those dimensional 5-year diversified and global bond trust dividends and take those tax credits and apply them against this CV method. So as I said, when we went back to that schedule, we found that it was only 4 dividends in there of all the $642. Only $7 worth related to these 2 shares. They are the only ones that I'm going to be able to claim. So that's just a brief example of a portfolio. As I said, the actual portfolio reports here aren't that relevant. That's only one company. They all look different. However, that's just to give you a bit of an example of where you need to dig into the reports to get more information and the kind of pages you're looking for. So the main ones that you're going to have to dig in is around those FIF shares and around lining those dividends up against that forced CV income. Otherwise, you can normally do the majority of it off the summary page at the start. So that concludes our webinar for this morning. Thank you all for joining us. Hope you've had some benefit from it. A number of questions going through, so hopefully we answered that. Just see there is one question I missed there. Why do we get the calls from IRD about KiwiSaver taxed at the wrong rate based on that year's income? Sometimes it can be a bit of misunderstanding from the IRD. Sometimes it can actually be meaning last year's income. So what they're saying is that you filed a tax return for 18. That 18 year has told us that we should be using, they're actually now asking about the rate that has been deducted in the current year, the 19 year. So they're not worried about the 18 year. They're worried about the fact that you're still running a 17.5% rate, for example, when your 18 year now tells us that the 19 year needs to be at 28%. So quite often it can be a discussion with them about what year they're doing. They're not looking at what has happened, they're looking at going forward, because the IRD can see what the current rate is that's being used in the current year. But it should be off the past 2 years. So you can simply say to them, if they are worried about the current year, what were the past 2? So looking forward, as I said, that's the conclusion of that webinar. What have we got coming up? We have our monthly tax update webinar on Friday the 17th of May. We have a special edition webinar about employment legislation hosted by Karen Phillips from our office and John Farrow from Anderson Lloyd. We've got a special edition webinar coming up about reporting for trusts, CRS and FATCA. We've got some more webinars in relation to AML compliance officer training. And we've got a special webinar for making delegation profitable for you. So quite a few webinars coming up in the next few months, and hopefully there might be something that you find of interest there. Otherwise, we will see you when you'll hear from us at the next Tech Savvy for those of you on our grad pack. and for those of you that choose to join us. So thank you again for coming, and hopefully you've had some benefit.